Hey guys, Toby Mathis here, and today we're going to be asking the simple question of what types of tech stocks are best suited to survive inflation. Now, unless you've been living under a rock, you've probably heard the very real fears of inflation running rampant, and that is because the monetary supply, in other words, the Fed, has been cranking out tons and tons of cash. In fact, estimates are well over north of 25% of all the cash in circulation has been created in the last year. And that is creating serious concerns amongst consumers that things are going to get more expensive. Obviously, there's lots of demand issues like in the housing market, and you're seeing housing prices go up, you're seeing oil prices go up, seeing food prices go up. That said, the Fed is still predicting around 2% inflation. Of course, they calculate the inflation somewhat interesting by not including some of those items, but that's beside the point. Now, here's the thing to consider is that when inflation starts to go up and the combat of it is really to lower interest rates, and as interest rates go lower, that allows growth stocks that need the cash and to borrow the cash to gain more value. On the same token, if the 10-year treasury rate starts to increase, that's going to push down on stocks. And so sometimes we're looking at the wrong thing. Like what should we really be looking at? What we should really be looking at is that 10-year treasury yield to see what it says. And it's telling us essentially not to worry too much about inflation. It's gone up, which is what's causing some of the tech bubble to push, the things to push down. I say the tech stocks, I could say the bubble because they're so overvalued right now. Like they're never in our history, except before the tech bubble burst 2000, have we seen these types of valuations. Makes a lot of people nervous. And so they start throwing around terms like there's going to be runaway inflation and the bubble burst is going to happen again. And the Fed is doing everything it can to make sure that doesn't happen. And there's an old statement that investors make, which don't fight the Fed. So I would say, based off of what we're seeing, you're not going to have crazy runaway inflation. It's going to be fought by lowering interest rates and keeping them really, really low. They're near historic lows now. Now, let me make this real for you so you understand what I'm saying. Let's say that housing prices have increased by 10%, but access to money has increased and has dropped. So it used to be if I got let's say $100,000 loan, I would pay $1,000 a month on it. Now I get $100,000 loan and I pay $500 a month on it. And the $1,000 a month is now what I would pay on a $200,000 loan. So even though the price of the house might have gone from 100 to 200, the actual expenditure to the individual, to the family, in most cases, didn't change all that much. So that's gone up, but the buying power increased because the interest rates went down. And that's kind of what you have as a competitive force. Now, what does that have to do with tech stocks? Whenever you see really high valuations and concerns of inflation, again, people are starting, they get nervous. They see these historic highs as far as these valuations, and you say that's because the money's so cheap. And then you start seeing that treasury yield tick up, and there's fear that the Fed's going to increase interest rates, and everybody loses their mind, and they think they're going to, that's when you'd see the market start to melt down. So the Fed has given out assurances. Don't worry, we're not doing anything crazy. We're going to keep money low. We're not so worried about inflation. They're trying to dissuade the panic that would occur. And what that just means for tech companies is that you're getting a reprieve for now. But let's say that doesn't go the way that we're thinking and that money starts to become more expensive. It's going to at some point. And all of a sudden your growth stocks, which rely on that, are not going to be as competitive. And there are already these historic valuations being based off of what they earn. The PE ratios are at historic highs, which again, it drives people that are technical nuts because they're saying, it's a bubble, it should burst, but they're not factoring in the fact that you have a Fed who's actively preventing the bubble from being burst, right? But that said, I would still focus in on the fundamentals of the companies and say, all right, what companies are going to be profitable regardless? And the good thing is history is kind of a great teacher. We can look back and say what types of companies have survived interest rate increases before, how did they do? And are they built to weather the storm? So like one that just immediately comes to mind with a high yield, low PE ratio, but always profitable is AT&T. It's been increasing its dividends for greater than 25 years. So it survived the tech bubble burst fine. It handled increases even at, increases before the recession, decreases after the recession. Its stock price doesn't do a tremendous amount. It doesn't fluctuate a ton. It's kind of been pushed down because there's fears that it has too much debt, but that debt's really, really cheap. So it's going to be one of those things where it's probably just going to be fine as wine. Other ones is you might be looking at is like the Broadcoms of the world, chip manufacturers, where there's a complete shortage at this time. And, even if you saw inflation start to creep up, those would be beneficiaries of that. And so you could start looking at certain companies, again, that tend to be more on the profitable side. I personally tend to look at companies that have been increasing their dividends for at least 10 years. Under these circumstances, you may want to look at 25 years, in which case you just threw out a lot of the growth stocks, right? There's just not a ton of them that have been around that long, making profit for that period of time. And then the other thing to consider is that this last year, everybody thinks, oh, the S&P's bumped up. It's been going gangbusters to a certain extent. If you looked at 2020, you could call it the S&P 5 instead of the S&P 500. There's really 5 companies that were responsible for, getting a positive year. If you didn't have those 5 companies, which is the Facebooks, Apple, Netflix, Google, even Microsoft, if you didn't have those, you would have had a very you would have had a meh kind of year. You would have had just an ordinary kind of a flat year, and that those ones were really pumping it up. Those would be the ones that I'd actually be focusing on and taking a look at. Like you have Amazon, which has really grown extensively in certain areas, not internationally, but domestically, definitely the dominating force. You look at those, Microsoft, where it's kind of diversified some of its offerings. Apple, which is always seems to be like they do pay out a small dividend, so like they're kind of the unusual company in there. You have Netflix, which seems to love it when was a beneficiary under the pandemic and changing the way that people consume their entertainment. Like you can still look at those companies and say they might be strong, but if their price gets pushed down, or if they don't continue to increase and their stock price doesn't go up, then you're kind of out of options as far as how you're going to get paid. Whereas if you focus on a company, again, that has a strong profit history that pays its shareholders in dividends, you're going to be much stronger in the long term. And so I guess if I was going to leave you with anything, look at the fundamentals of companies. The traditional growth stock, I'm not going to say yay or nay. I'm going to say that you're taking a pretty big risk, and I would tend to focus, if depending on what your risk tolerance is, I would tend to focus on companies that even if we did see some inflation pop up, and even if we did see some negativity in the economy or the interest rates start to pop up or something along those lines, which again, if inflation goes up, interest rates are probably going to stay low. But even if you did, even if you said, oh, there's not that much inflation, the treasury keeps going up as far as the yield keeps going up, the 10-year treasury yield, and it starts to affect these companies, and you don't want to play in that field, focus on the companies that are making a profit regardless, because then you're receiving profits throughout it, and they've already shown a propensity to be profitable during that period of time. So I'll part you with that little bit of advice, is to really start paying attention instead of this unfettered, unreasonable, never-ending growth. There's just only so high they can go. You're going to hear contrary words out there as they say the money stays cheap and this is the time to get in. All those good things. I'm not saying that they're necessarily wrong. I'm just saying that you're taking a lot of risk because they might not be right.